Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries, typically using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on ospreystrategic.org as well as StockCharts.com. So what I wanted to talk about this week is the financials are in focus, and there's a couple of reasons to focus in on the financials. I know I've covered them off before and they've been weak, and what happened so far is they actually started to turn, but there's a reason for them to turn and to do really well in this market environment. So in the early recession environment, they're actually favored to do well in this backdrop. So I want to cover that off. So I'm going to cover off a little bit about how the market is trying to rally here. The oil's stall, but the banks are starting to haul. And our opportunity here is to try and catch where the puck is going. And one of the things we're starting to see is these financials behave pretty well, and I want to show that in detail. So if you have any questions about what we do on ospreystrategic.org, you could try our membership service. An annual membership is only $860 a year, about $17 a week, or you could try 1 month at just $7. The idea being we're trying to help you find when is a good time to enter the market. So if you think the market rally that we started last Thursday is a good place to look, and we're up about 8% off the lows, then you'd appreciate the new service that we have. We were looking for a rally to start late last week and head up, and now we're looking for that market rally to continue. We have options expiration on Friday, but essentially we're starting to see the tools needed for this market rally to start. So if you'd like that kind of notice, then feel free to give our service a try. So what I want to cover off now, actually let's do the actual S&P first and just talk about that. So here's the 60-minute chart, and you can just see we're chopping around in a range going back to September 28th. Now it all looks so good when we show it like this. It's that larger context that makes it a little bit more awkward, and that would be just that we're down drilling in the bottom right-hand corner of the page. Now, a couple of things I want to point out here. First of all, we had bullish divergence on the lows, so we had a higher low in momentum and a lower low in price here. And then we don't use the bottom here as it's the closing low that the indicators are using to calculate. So when this is calculating this momentum low, it's using the closing price up here or in here compared with this price over here. So again, we still made a lower low here, but we're making a nice higher low on that one. That's on the S&P, and on the NASDAQ, obviously we know that's where the trouble has been centered. We're down 38% off the highs. But again, we had a pretty continuous downfall here, and we weren't making lower lows. It was still low, and normally you kind of want to make a higher low, but you could see we made this sort of a low back in May as well and went on a really good run. The real question is it a one-day run or does it have more to go? And some of my internal data suggests that we're actually seeing some changes. I calculate a whole bunch of stuff on spreadsheets for those that have seen that kind of calculation, and I calculate my Schnell strength indexes. What we're seeing in the background, as an example, is there's already over 1,000 stocks that are up more than 5% this week. And it's only Tuesday, so that's a pretty rip-roaring rally. It's that kind of setup that we'd like. Now we're trying to break through the 20-day moving average, and the NASDAQ closed just below that, and the S&P closed just above that. Again, we'd like to see this kind of rip up. Obviously, when we get to the 50 up here, another 20 points higher, that would be one place to watch for, and then the second place would be the 200-day moving average up around 410 on the SPY. So all of those are coming into context now. The other thing I want to show you is the bonds, and what I want to show on the bonds specifically is this look. So this is the 5-year daily, and obviously the uptrend is continuing, but we also have some divergence here with the PPO, and what you can see is we recently tried to get back through the signal line and couldn't. Now that doesn't mean that we will vault higher. Could be that we just kind of roll over and go sideways. But I think what the stock market's worried about is it continuing to go up. So if it just started to level off and go sideways, that would be helpful. And again, we're up around 4.2% on the 5 year, so that makes it a little bit stretched out. The 10-year is now under 4%, but holding right around the 4% level. Now on the 2 year, this has been a ballistic move from September of last year all the way up. And you can see we have this trend line in place, and whatever, I could fine tune the trend line so it's either touching these 2 points here, or I could fine tune it and have these 2 points here touching, and it would come in a little bit lower. I think what's really important to understand is the context of the overall picture. So if the Fed has another 1.5% to go, that's roughly what's estimated. But if all of a sudden the data starts to come in really weak and it looks like they might only have to go, let's say 0.25 instead on the second meeting rather than going the full 0.75 on the second meeting from now, that could really change the market quickly. And so most people are starting to look for that. There's some really dramatic effects that we're worried about from the speed of the rise of the Fed change here. So the rate of change for them to get from where they were to up around 4% so quickly is what's causing the consternation. So all of these large pension funds and stuff that are having a bad year because both bonds and stocks have fallen. And obviously bonds were to offset their downside risk. And now with them both falling, they've got problems in the way the pension fund is structured. So that creates issues. But the speed of the move is also what creates the issue. So what we want to watch for here is just, can this finally start to moderate? And any sort of hope along that line should probably help us. Now you can see on the first part of the move here back in September, this thing was really aggressively flying. And when you look at this 2 year, there's no real change, right? We get to the beginning of the year and this just kept going on. But obviously the stock market wasn't kind of in agreement with that move. What we saw was the PPO momentum was very, very high, and now it's a lot less. Now it's still not low, and I would just say, if it starts to get down here around, say 2% or something like that, starts to really weaken, you'll have kind of had your big move, then your little move, and that's the kind of thing we'd look for a momentum change to start. The economy should go through a place in time where the Fed is done raising interest rates and the economy is slowing, but it's still doing okay. And then as the economy suffers, then the Fed starts to cut the interest rates. And so in that lull in the middle there, we could have a nice position for the stock market. We want to keep watching. Perhaps we've already started that, but that's the kind of area that we want to look for in the market. Now, looking at the 2 year, at the 3 month, this thing, I've got this little picture here, and I want to show you where it was at in December, and I started to write, wow, this thing's really starting to kick around. Oh my. And then let me just unwind the tape and show you what happened from that little wow. And this is where the wow was, so you can't even see that blip on the screen, and we have literally gone vertical. So from a 0% interest rate to 3.8%, and there's no sign of this easing off. However, I would just say it does look, pretty much a ballistic move to the upside, and eventually when that ends, it'll probably roll over equally quick. Now, when we look at I think I have one more picture here, the bigger picture on this, you can see it's not uncommon for the 3 month to move up quickly, right? It did in 04 to 06, a 2 year period. The problem is we made the same kind of move that took 2 years back then, and we've made that same move in about 9 months, I guess 9.5 months now. So The speed has been twice as quick as back in that time, and you might remember that we ended up having a bit of a housing problem because of the change in financial circumstance for people trying to get a mortgage, etc. So we're not in unprecedented waters. It's just the speed that we're going through the change is a little bit quicker than we're used to. So I want to keep that in mind as I go forward here. But to me, it looks like we're starting to get stretched. There's a few economic indicators that are starting to pause. And so I'll call it the dilemma that the Fed is in might soften, and that might help us. Now, if you look at the 10-year, the 30-year minus the 10-year, what you see on this chart, this is up at the top. There's only been a couple of periods where we dipped below this zero line. Typically, we'd bounce off that line. But if you look in 2000 and 2007, that was meaningful. But I will say that back then, what was interesting was the stock market decline actually started when these things started to normalize. This week, we've now had the 10-year interest rate is now higher than the 30-year. So the 10-year interest rate is now higher than the 30-year interest rate. I think I still got that backwards. Sorry, it's lower. What I wanted to try and show you, let's just go to this chart here. This is the spread, and what it shows on the spread here is the 10-year was underperforming this black line, which is the 30-year, and now we're watching for that to flip the other way. So the 10-year should end up being back above the 30-year, and it's the spread between the two that should make the difference for us. And so as we watch here, the 30 years at 4.04 and the 10-year here is at 4.01, but it's when this normalizes and flips the other way that would make the change for us. So I want to keep that in mind as we're going forward. That's what we're starting to look for, is this yield curve to normalize. But again, once we normalize, it doesn't necessarily mean we're out of the woods. It just means that it's worth paying attention to, because if the market's already priced in all these problems, that would be hard to imagine that we could have. But without question, a big rally in the middle here can be very, very helpful. So it's by watching these yield curves invert and watching the change in behavior, that's when we're starting to expect some of this stuff to happen. As we go through that, I'll call it the hump in the middle, after the Fed's done tightening and before the Fed starts easing, that particular area is something we want to watch for potential upside. Now, this week we got a little bit of a change in something called the high yield. What happened was the high yield, you can see on the zoom panel here, started to make a higher high and a higher low. That was the same sort of thing we made in June, and we went on a nice 2-month run. The real question here, what I like, is back in June, see how far the PPO was away from this trend line? Well, now we've made kind of a run up, a pullback, and what we'd expect now is this breaks through, and that actually changes the trend. If that was to happen, that would be very bullish for us. Now, when you read the PPO, one of the things you'll see is that there's a big accelerant, and then as you near the end, it kind of goes on one last hurrah. But the momentum isn't nearly as severe, and then it changes trend. That's what we're watching for now, and you can see this on the way up here. We had this really far away from the trend line, came back down, went for one last hurrah, and then started to roll back over. So we see this back here in this period. Now it's on the negative side, watching this yield curve behave, or this momentum of the yield curve behave. So now what we'd be watching for is this starts to push to the upside, meaning people want to buy the high yield bond. So that would be a bit of a risk on indicator. The other thing I've been watching is that while all this is going on, I've been keeping track of the high yield and the 7 to 10 year bond. And what I want to watch on this particular indicator is not just the yield and the bond price. I just want to watch the bond price. So StockCharts puts a total return on, which gives you the return for both the yield, so it'll add the dividend in every time, calculating how the stock has performed or the ticker symbol has performed. What I've done is by using a hyphen at the front, that takes the yield off. I don't get the yield added back in. And so now I've got this big downtrend line, and what you see here that's been going on really since COVID started is high yield has been slightly underperforming the 7 to 10 year bond. And what I wrote on here was around the beginning of October was that this is a potentially explosive chart signaling a bull move for the markets. Sure enough, we're breaking out here, and we're also breaking out in momentum heading back above zero. And as I mentioned before, you've got this big PPO pocket with a smaller pocket. These are still big pockets because this is almost 6 months. But the idea that we're watching for is a real change in that momentum behavior. And if this soars and we start to see high yield outperform, it means the market's looking 6 months ahead. They're not going to wait for the day the Fed doesn't finally move. Much like this recession, they've priced it in by dropping the stock market 38% on the NASDAQ and 27% on the S&P. And now we start to rally out of this hole, and the stock market could actually rally while the recession is going on in America because they're looking ahead at future earnings growth starting to improve. So all of these charts are starting to line up of at least a time of interest, and that's what I wanted to point out today. But the second biggest gainer from this sort of profile, where what they pay to clients to have their money in the bank and what they're getting in terms of loan yield when they loan it out. Let's say they're giving us zero on a savings account or very close to, and they're loaning it out at 5%. Well, all of a sudden they're making this 5% spread, so they get a little bit excited and it shows up on their bottom line. Creating that, what I wanted to show, this is set up, these are just an ETF, a list of banks that are doing pretty well. But it's all the major banks around the world, and I put them all into one chart list. So it's not huge, but it's the big ones. And I think what's really important when you look at this top of the list for who performed well over the last week, obviously, I'll highlight these big green bars over here, but here's Bank of America, and it's moved up 3.75%. This is set to intraday. Let me just go back to that 1 week model. And here you go, the 17% for Bank of America, 16% for JP Morgan, 11% for Wells Fargo. And I wrote an article about this just a couple of days ago, how the banks are starting to show some pretty good improvement. So if you're watching these banks and they're starting to turn, this is a reason to at least pay attention so that if the banks do start to rock, that you can make some money. And I'll just show one more thing. Many of you will have seen this StockCharts sector rotation model, but when we're in the early part of a recession and then full recession, the bottom line is that the areas of the market that do well are typically healthcare, financials, real estate towards the early recession, and materials and energy are more when the stock market is topping out. So this is market top in orange here, and a bear market in the bottom. And then so as the bear market bottoms out, we see the financials and real estate start to do well, and then we head over to this other side, and technology and discretionary start to lead us out of this hole while the economy is still in a full recession mode. That's what makes investing hard, is trying to figure out where it's moving to next. And one of the things I think we're seeing here is the banks are all set up to put a nice move higher. So while they could stall here because they've already had a big move this week, we've been talking about it for a little while. And as they're coming through this model, pulling forward, these charts are starting to improve. Now, they're not beautiful by any stretch of the imagination. This is just a daily chart. But what you can see here is there's a downtrend going on for a couple of months, and we're starting to break that to the upside. And when I go to a weekly, it doesn't look like much, but I think it's pretty clear that this sort of trend break is showing up. Scooter ranking up around 75 for the first time since October of 2021. So this is the best real performance out of the banks for a while. And you can see when we had that kind of lull in 2020 and then all of a sudden the banks became some of the top performers. Look at the change in the shape of the price chart where these really accelerated higher. So while this scooter ranking is suggesting they're a pretty strong group, this is the first week of them breaking the trend. The relative strength is just starting to hit 3-month highs. All of these things are starting to set up to make the stocks look pretty good. They also broke a big downsloping trend line on PPO momentum this week. And to me, this is a real good clue that the momentum is changing, not just the price, but the actual long-term momentum, which has been a 1.5 year downtrend, where the upward momentum of the banks has been weaker and weaker and weaker, is now starting to change and move higher. So this is a really prominent place for me to like to get involved in. You can see if we put that on the chart over here on the left hand side, this would also be obviously a nice place to get involved. Anyway, the idea isn't to just go give you a whole bunch of bank charts that look good. I think we all know that they've popped nicely. What I would suggest is I've ranked them by scooter ranking here. And if you do that, that's going to bring the strongest charts to the top. And what you're looking for is charts, this one looks set to break out, Thursday or Friday of this week. PPO momentum on the dailies just turning up above 0. That's a pretty nice place to get on board. Here's Unibanco. Again, if you're interested in foreign banks, you could find them on these lists. But my big thing here is if the yield spread between what they pay the depositor and what they get from clients who are borrowing money is so big. So instead of 1 or 2%, it's 5%. That can be a real meaningful place for them to want to get on board and should see some really nice profits at the end. So is a recession coming? Probably, but we don't need to focus on that yet. What we want to focus on is a nice, say, 1 or 2 month run. Hopefully these things can run up into December and then maybe we'll worry about it then. But the charts in general look like they're setting up for that sort of potential breakout. Now, I think we all know that Credit Suisse had needed some additional capital, and apparently they've hired a couple of banks to go and help them raise that money. With that, that should help stabilize that particular chart. The other thing, this is Commerzbank out of Germany, but even this chart is starting to turn up. And if we go to a weekly chart, well, it's not pretty, it's not horrible, it's not a Credit Suisse chart pointed kind of straight down. Just to give you an idea, here was Credit Suisse. So it's the idea that these charts are starting to improve, and if they can turn up, this one's just got a little bit more to go to kind of break that downtrend. PPO moving above 0, all of that would look pretty good for us as we move towards the end of the year. So I think that's pretty exciting. What I want to watch for is I want to make sure that the actual indexes can continue to push up, and the NASDAQ literally has, I think that's this chart over here, has 25% to go just to get back to the 200-day moving average, and it has almost 60% to go to get back to its its November highs. That's a dramatic level that we can go up before we start getting to old highs. So I think if there's some opportunity here, one of the areas I like is the financials. I still continue to think the energy stocks are going to set up pretty well in the fourth quarter, just with the volume of production and the relative demand. So as long as demand doesn't fall off a cliff, I think we could see some nice acceleration in that too. But this bank area to me looks like it's setting up very, very nicely. And I don't want to hang my hat on an old sector that was doing well. I'd like to watch for the other new sectors start to pick it up. So I'm watching for the financials here, and I'd also like to lean my eyes over towards the consumer discretionary and some of those charts. Lastly, let's wrap it up with Tesla, who reports tomorrow, and Netflix, who reported tonight. So what you see on Netflix, it was hovering in around kind of a 2-week range and literally popped up. Here's the daily chart. It's going to come in up 10% or something tomorrow. Now, Tesla has started to try and make a bottom here. And again, they make earnings tomorrow night. If that's a bomb, we could see another pullback on earnings. We do have options expiration on Friday. Hopefully we'll get another area where the market can stabilize and we try to push higher. So watching for those couple of things, and hopefully with that we can continue to rally into November and December. With that, thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesdays at 10:30 a.m. Eastern Time, and you can also see the recording on StockCharts TV YouTube page. Thanks, everybody. Bye-bye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.